Welcome to EnrichMinds.com and our session on bonds. This is our second session on a specific asset class since we covered stocks in our last session. In the next few sessions, we shall study one asset class at a time. In today's session, we shall study what bonds are. We shall also learn about the different kinds of bonds. How and why should we consider bonds for investing, and how we can benefit from bonds. We shall also learn about some of the risks associated with investing in bonds. First, let's look at what are bonds. Bonds are units of debt issued by companies and securitized as tradable assets. When bonds are issued by companies or businesses, they are called corporate bonds. When they are issued by a government, they are called government bonds. A bond is referred to as a fixed income instrument since bonds traditionally paid a fixed interest rate, coupon, to debt holders. Variable or floating interest rates are also now quite common. Bond prices are inversely correlated with interest rates. When rates go up, bond prices fall, and vice versa. Bonds have maturity dates at which point the principal amount must be paid back in full or risk default. Governments at all levels and corporations commonly use bonds in order to borrow money. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as a document that acknowledges debt between the lender and borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer. Bond details include the end date when the principal of the loan is due to be paid to the bond owner and usually includes the terms for variable or fixed interest payments made by the borrower. Let's see an example of a bond. Consider the case of ABC Corporation. ABC wishes to borrow $1 million to finance construction of a new factory, but is unable to obtain financing from a bank. Instead, ABC decides to raise the money by selling $1 million worth of bonds to investors. Under the terms of the bond, ABC promises to pay its bondholders 5% interest per year for 5 years, with interest paid semi-annually. This 5-year period is the maturity of the bond. Each of the bonds has a face value of $1,000, meaning ABC is selling a total of 1,000 bonds, or 1,000 bonds of $1,000 value each, and the 5% interest is called its coupon rate. The first recorded bond dates back to 2400 BC, a stone discovered at Nippur in Mesopotamia in present-day Iraq. The bond guaranteed the payment of grain by the principal, and the surety bond guaranteed reimbursement if the principal failed to make payment. Corn was the currency of that period. How does a bond work? Many corporate and government bonds are publicly traded. Others are traded only over the counter or OTC, or privately between the borrower and lender. When companies or other entities need to raise money to finance new projects, maintain ongoing operations, or refinance existing debts, they may issue bonds directly to investors. The borrower or issuer issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loaned funds or bond principal must be paid back, or the maturity date. The interest payment, or coupon, is part of the return that bondholders earn for loaning their funds to the issuer. The interest rate that determines the payment is called the coupon rate. The initial price of most bonds is typically set at par, usually $100 or $1,000 face value per individual bond. The actual market price depends on many factors: the credit quality of the issuer, the length of time until expiration, the coupon rate compared to the general interest rate at the time. The face value of the bond is what will be paid back to the borrower when the bond matures. Most bonds can be sold by the bondholder to other investors after they have been issued. So a bond investor does not have to hold a bond all the way through to its maturity date. It is also common for bonds to be repurchased by the borrower if interest rates decline, or if the borrower's credit has improved and it can reissue new bonds at a lower cost. If you were to buy a bond, would you buy a government bond or a corporate bond? There is no right answer. It depends on your risk appetite and the creditworthiness of the issuer. In general, your own government bonds are less risky than corporate bonds. Now that we know what a bond is, let's look at the various features of a bond. Bonds have some main characteristics that distinguish them from stocks. First, fixed interest rate. Most bonds pay a set rate that never changes. If a bond has a face value of $1,000 and a 5% interest rate, it pays $50 per year. Always remember the coupon rate is determined on the basis of the face value and hence is always fixed and not on the price you may have paid for the bond. Second, maturity date. Some bonds mature after 30 years and some after 1 year. But most bonds have a specific end date on which they repay your initial investment. The maturity date is when the issuer has to repay the face value to the bond holder. Third, credit rating. A credit rating assesses how likely a particular bond issuer is to make its interest and principal payments. Top-notch bonds are rated AAA. Low-rated bonds are called junk bonds. They pay higher interest rates, but because they are issued by financially shaky companies, they are more likely to default. Lower risk and lower returns. Bonds generally return less and are less risky than stocks. Bonds are harder to buy and sell. Stocks are easy to trade with any major broker. But it can be hard to buy individual bonds on your own, and you often don't get a great price if you need to sell them. In 1997, David Bowie sold bonds that gave bondholders the right to his royalty income. The Bowie bonds paid 8%. Disney, Coca-Cola, and the countries of Argentina and Austria have all issued 100-year bonds. Fourth, issuer. The entity that issues the bond and promises to pay the coupons and the face value at maturity is the issuer. If a company issues a bond, it is called a corporate bond. If a national government issues a bond, it is called a government bond. If a city or municipality issues a bond, it is called a muni or a municipal bond. This is a pictorial depiction of what a bond used to look like historically. In the past, a paper bond was issued for safekeeping by the issuer, but nowadays everything is done electronically. Yet, the features all remain the same. Starting from the top, we see bond issuer, coupon rate, date of issue, semi-annual payments of coupons, bondholder, face value of the bond, and maturity date. The two most important features of a bond are, first, its credit quality, and second, the time to maturity. The better the credit quality, the lower the interest rate and lower the risk. Interest rate is directly proportional to risk. An interest rate demanded by investors is directly linked to the credit rating. The longer the maturity date, the higher the risk. Projecting out the future is more treacherous the further the time period is in the future. In other words, there is greater uncertainty the further the date is in the future. Credit ratings for bonds and issuers are generated by credit rating agencies like Standard & Poor's, Moody's, and Fitch Ratings. The very highest quality bonds are called investment grade and include debt issued by the U.S. government and very stable companies like many utilities. Bonds that are not considered investment grade but are not in default are called high yield or junk bonds. These bonds have a higher risk of default in the future, and investors demand a higher coupon payment to compensate for the risk. Let's understand what the face value of a bond is. Most bonds share some common basic characteristics, including face value. Face value is the money amount the bond will be worth at maturity. It is also the reference amount the bond issuer uses when calculating interest payments. Most bonds have a face value of $1,000 each. For example, say one investor purchases one bond for a premium, $1,090, and another investor buys the same bond later when it is trading at a discount for $980. When the bond matures, both investors will receive $1,000, the face value of the bond. Issue price. The price at which the bond is first issued to the bondholder is called the issue price. It often differs from the face value. The issue price depends on the relative values of the coupon rate and the interest rate or yield expected by the buyer. If the yield expected is higher than the coupon rate, the buyer will pay less than the face value and the bond is said to be issued at a discount. If the yield expected is lower than the coupon rate, the buyer will pay more than the face value and the bond is said to be issued at a premium. If the yield expected is the same as the coupon rate, the buyer will pay exactly the face value and the bond is said to be issued at par. Issuer. The entity that issues the bond and promises to pay the coupons and the face value at maturity is the issuer. If a company issues a bond, it is called a corporate bond. If a national government issues a bond, it is called a government bond. If a city or municipality issues a bond, it is called a muni or a municipal bond. The person or entity that buys the bonds and lends the money to the issuer is called the bondholder. If you were to buy a bond, you would be the bondholder of that bond. The coupon rate is the rate of interest the bond issuer will pay on the face value of the bond, expressed as a percentage. For example, a 5% coupon rate means that bondholders will receive 5% times $1,000 face value, or equal to $50 every year. Coupon dates are the dates at which the bond issuer will make interest payments. Payments can be made in any interval, but the standard is semi-annual payments. The maturity date is the date on which the bond will mature, and the bond issuer will pay the bondholder the face value of the bond. While the coupon rate determines the periodic payments by the bond issuer, the current yield is calculated by that fixed payment divided by the price one paid for the bond. For example, if you purchased a bond that pays 5% coupon on a face value of $1,000, for $950, for example, the current yield is equivalent to $50 divided by $950 equal to 5.26%. When investors consider buying bonds, they look at two vital pieces of information: the yield to maturity, or YTM, and the coupon rate. The yield to maturity, or YTM, is the percentage rate of return for a bond, assuming that the investor holds the asset until its maturity date. It is the sum of all of its remaining coupon payments. A bond's yield to maturity rises or falls depending on its market value and how many payments remain to be made. The coupon rate is the annual amount of interest that the owner of the bond will receive. A bond investor or a trader considers the YTM in deciding how much to pay for a bond. Said another way, it is the YTM that determines whether a bond trader or buyer will pay a premium or a discount to the face value of a bond. Let's watch a short video courtesy of Investopedia.
A bond's coupon rate is the amount of interest income it earns each year based on its face value. A bond's yield to maturity is its total estimated return if the bond is held until maturity. Investors base investing decisions and strategies on yield to maturity more so than coupon rates. Suppose a bond has $1,000 face value and issues semi-annual interest payments of $20, totaling $40 a year. Its coupon rate is 4%. That coupon is fixed. No matter what the price the bond trades for, it will pay $40 a year in interest. A bond's yield and its price are inversely related. At face value, a bond's yield and coupon rate are the same. But if the same bond sells at a premium price of $1,100 and its yield is 3.63%, or $40 divided by $1,100, yield to maturity approximates a bond's average return until it matures. It applies a single discount rate to all future interest payments in order to create a present value that's close to the price of the bond. The calculation includes the coupon rate, the price of the bond, the difference between price and face value, and time until maturity.
Now let's look at the types of bonds. The main four categories of bonds by issuer. First, treasuries, issued by the U.S. federal government. You get a tax break on your state and local taxes on your interest income from treasuries. Second, munis or municipals, issued by state and local governments and related entities. You typically get a tax break on your federal taxes on interest income and sometimes on state and local taxes as well. Third, corporates, issued by corporations. There are no tax breaks on interest income. Fourth, foreign, issued by foreign governments or corporations. The risk and return characteristics of foreign bonds can vary widely depending on the particular issuer. First, let's understand treasuries. Government bonds are issued by the United States Treasury. Bonds issued by the Treasury with a year or less to maturity are called T-bills. Bonds issued with 1 to 10 years to maturity are called T-notes. Bonds issued with more than 10 years to maturity are called T-bonds. Agency bonds are those issued by government-affiliated organizations such as Fannie Mae or Freddie Mac. Now let's look at corporate bonds and munis. Corporate bonds are issued by companies. Companies issue bonds rather than seek bank loans. Bond markets offer more favorable terms and lower interest rates. Municipal bonds are issued by states and municipalities. Some municipal bonds offer tax-free coupon income for investors. There are various kinds of bonds based on their attributes. The four most important or common kinds are: first, zero coupon bonds. These do not pay coupon payments and instead are issued at a discount to their par value that will generate a return once the bondholder is paid the full face value when the bond matures. U.S. Treasury bills are a zero coupon bond. Second, convertible bonds. These are debt instruments with an embedded option that allows bondholders to convert their debt into stock or equity at some point, depending on certain conditions like the share price. Third, callable bonds. These also have an embedded option, but it is different than what is found in a convertible bond. A callable bond is one that can be called back by the issuer before it matures. This typically happens in a falling interest rate environment where the issuer can raise the same funds at a lower rate than they are paying on the bond. And fourth, a puttable bond. These allow the bondholders to put or sell the bond back to the company before it has matured. This is valuable for investors who are worried that a bond may fall in value, or if they think interest rates will rise and they want to get their principal back before the bond falls in value. We shall discuss each kind of bond in more detail next. First, let's understand zero coupon bonds. Zero coupon bonds do not pay coupon payments. Instead, they are issued at a discount to their par value that will generate a return once the bondholder is paid the full face value when the bond matures. United States Treasury bills are zero coupon bonds. Convertible bonds are debt instruments with an embedded option that allows the bondholders to convert their debt into stock or equity at some point, depending on certain conditions like the share price. For example, imagine a company that needs to borrow $1 million to fund a new project. They could borrow by issuing bonds with a 12% coupon that matures in 10 years. However, if they knew that there were some investors willing to buy bonds with an 8% coupon that allowed them to convert the bond into stock, if the stock's price rose above a certain value, they might prefer to issue those. The convertibility feature increases the price the issuer receives from the bondholder because of the embedded option. Next up is a callable bond. Callable bonds also have an embedded option, but it is different than what is found in a convertible bond. A callable bond is one that can be called back by the company prior to maturity. Assume that a company has borrowed $1 million by issuing bonds with a 10% coupon that matures in 10 years. If interest rates decline in year 5, then the company could borrow for 8%. They will call or buy back the bonds from the bondholders and reissue new bonds at a lower coupon rate. The callable bond lowers the price a bondholder or buyer would be willing to pay for a bond. Finally, a puttable bond. A puttable bond allows the bondholders to sell the bond back to the company before it has matured. This is valuable for investors who are worried that a bond may fall in value, or if they think interest rates will rise and they want to get their principal back before the bond falls in value. The bond issuer may include a put option in the bond that benefits the bondholders in return for a lower coupon rate or just to induce the bond sellers to make the initial loan. The puttable bond increases the price a bondholder or buyer would be willing to pay for a bond. While bonds are considered a safer option than stocks, bonds do have plenty of risks, including: first, liquidity risk. This describes how easy it is to sell your bond for its market value. Liquid bonds like treasuries are usually easier to sell than illiquid bonds such as those from risky companies or small nations. Second, credit risk. Occasionally, a bond issuer runs into serious financial trouble and cannot pay its debts. This is called defaulting. Junk bonds have more credit risk, while United States Treasury bonds have almost no credit risk. Third, interest rate risk. When interest rates rise, bond prices fall and vice versa. Although bond prices are generally much less volatile than stocks, big rises in interest rates can, and sometimes do, cause even safe bonds to lose money. Fourth, inflation risk. Rising inflation can cause interest rates to rise, driving bond prices down. Low-returning bonds, such as treasuries, also run the risk of failing to keep pace with inflation, like if a bond pays 2% interest, but inflation is 3%. Fifth, prepayment risk. A bond issuer could decide to pay off a bond before it matures. This happens most often when interest rates fall. Although it may not sound so bad to get your money back early, the downside is that you'll typically be stuck reinvesting that money in a different bond that pays a lower interest rate. Now we shall next look at how we can buy bonds. It is a little more involved than buying stock or shares. Let's look at how bonds are priced first. A bond's price changes on a daily basis, just like that of any other publicly traded security, where supply and demand in any given moment determines that observed price. But there is a logic to how bonds are valued. Up to this point, we have talked about bonds as if every investor holds them to maturity. It is true that if you do this, you are guaranteed to get your principal back plus interest. However, a bond does not have to be held to maturity. At any time, a bondholder can sell their bonds in the open market, where the price can fluctuate. Next, let's look at how we can buy a bond. Unlike stocks, most bonds are not traded publicly on an exchange, but rather trade over the counter or OTC, which means you must use a broker. Treasury bonds, however, are an exception. You can buy those directly from the government without going through any middleman. The problem with this system is that because bond transactions do not occur in a centralized location, investors have a harder time knowing whether they are getting a fair price. A broker, for example, might sell a certain bond at a premium, meaning above its face value. Bonds offer a safer investment choice than shares or equities, and they generate current income. You expect to get all your money back when the bond matures. And if the bond prices rise, you could sell for some profit too. But the downside is that bonds offer lower returns compared to equities or shares, and companies that issue bonds may fail to deliver on their promise, and hence both principal and interest payments may be at some risk. Let's watch a short video on bonds courtesy of Investopedia.
Bonds are units of debt issued by companies or governments that are converted into tradable assets. Essentially, bonds are used to borrow money. For example, governments use bonds to borrow money to pay for schools, roads, and other infrastructure. War can also create a sudden need for funds. There are basically four primary categories of bonds sold in the markets: corporate bonds issued by companies, municipal bonds issued by states and municipalities, government bonds issued by the U.S. Treasury, and agency bonds issued by government-affiliated organizations such as Fannie Mae. For investors, bonds are thought of as fixed income instruments because they typically pay a fixed interest rate, or coupon rate, to bondholders, although bonds with variable interest rates are also common. Most bonds share common characteristics. The issue price is the price at which the bond issuer originally sells the bond. The face value is the amount the bond will be worth at maturity. The coupon rate is the percentage of interest the issuer will pay on the bond. The coupon date is the date on which the issuer will make interest payments. And the maturity date is when the bond matures and the issuer pays the bond's face value. The bond market also tends to move inversely with interest rates. So bonds will trade at a discount when interest rates rise and at a higher price when interest rates fall. In short, a bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments.
In summary then, our main takeaways today are: first, bonds are debts. When you buy a bond, you become a lender and the issuer becomes a borrower. Bonds generally pay a set interest rate and mature on a particular date. Second, they are generally less risky than stocks and return less than stocks. Third, investing through a bond fund can be more convenient and less risky than holding individual bonds. Thank you for your time. Until next time then, stay enriched and strong.